So let's look at a partial lease termination at Precision Industrial. In this example, we'll assume that we've agreed with the landlord to reduce the square footage we're renting at our warehouse in Denver by 30%. And in exchange, the landlord has agreed to reduce our monthly payments by 20%. And this amendment will take effect on January 1st, 2028. So this will follow the same remeasurement process for the liability that we've used for previous remeasurements and modifications. But the right of use asset behaves differently. ASC 842 provides two methods for adjusting the right of use asset when a partial termination occurs. Before we look at those though, let's first calculate the modified lease liability. We followed this process several times now, so let's try to do this quickly. We'll rename our sheet to 5.1, make a copy into our archived section, change that name back to 5.0, and then in our archive schedule here, we'll copy everything and paste as values, and highlight our final period before the partial termination. That will be December 2027. So we'll highlight it orange. Then we'll update the background color of this 5.1 tab, freeze everything pre-modification, that will be up to period 20, give that portion a light gray background, highlight the December 2027 row orange, and break this into pre and post partial termination sections. Okay, now let's work on our schedule a little bit. We'll update this to period 0, set the date to our effective date, then the period 1 date will be the end of the same month. We'll highlight those two cells for inconsistency and zero out the interest in our opening period. Then down at the bottom, we'll add a row to our schedule because we stole one for that opening period 0. Copy this down. And then we'll update our totals, so we'll call these post-modification totals. And we'll use a SUMIFS to sum up everything on our schedule on or after the effective date. Then let's lock our cells here. And before we copy this over, let's add our entire lease totals as well. So we'll copy down this row, we'll call this lease totals, and simply sum up the amounts across our entire lease term. And then we can copy both these formulas over for each of the items. Then the last thing we need to do as far as our liability is concerned is update our long-term balance formula. We want to add that same criterion where we only sum up the principal amounts on or after the effective date. And we'll lock these cells and copy this down. Okay, so with our liability schedule taken care of, we can now go update our lease list. We'll change this identifier to 5.1. For the measurement trigger, we'll call this a modification. Under ASC 842, partial terminations fall under the modification category. Then the effective date is January 1st, 2028. The remaining term after the partial termination is 16 months. And then for this type of modification, we are required to reassess the discount rate and the classification. For our example, let's assume our incremental borrowing rate has changed to 7.6%. And then, although we would normally reevaluate classification after calculating the new liability, for efficiency in this episode, let's just assume the lease remains an operating lease. So now returning to our schedule, we'll update the identifier to 5.1, and then work on our payment schedule a little bit. So this first row here, these all take place before our partial termination, so we can just delete this. Then the same is true of our incentive. You can see on our schedule that's already occurred in April of 2027, so we can delete this as well. Then the first payment after our partial modification will be on January 31st, 2028. And then recall, as part of the amendment, the landlord has agreed to reduce our rent by 20%. So we'll update the payments to 80% of their original amount. We'll just convert these to a formula and say equals 0.8 multiplied by the original payment. And with that, you can see we've calculated our new present value of the future payments post-modification of $144,652.75. So let's set our opening balance here equal to that amount. And if we just do some scratch work here, let's take our remeasured liability less the amount immediately before the modification, and you can see this represents a reduction in the liability of $36,274. Previously, for modifications, we adjusted the right-of-use asset by the exact change in the lease liability. But for a partial termination, ASC 842 takes a different approach. The implementation guidance outlines two acceptable methods for adjusting the right-of-use asset. And in practice, this is treated as an accounting policy election that we'd want to apply consistently. Under the first method, which is described in the implementation guidance in paragraphs 842, 10, 55, 181, and 182, we calculate the percentage change in the liability before and after the modification. In our case, the liability decreased by 20.1%, which is $36,374 divided by $180,927. Method 1 requires us to reduce the right-of-use asset by the same 20.1% and recognize any remaining difference as a gain or loss. The challenge with this approach is that the change in the liability may not always reflect the economic reduction in the right-of-use. For example, if the original lease included variable payments tied to the CPI, and the CPI has increased significantly since commencement, the liability could increase even though the right-of-use asset should decrease. In those situations, Method 1 may not be appropriate. Because of those potential inconsistencies, I prefer the second approach the standard describes in paragraphs 842, 10, 55, 183 to 185, which bases the adjustment on the remaining right-of-use. This method aligns directly with paragraph 842, 10, 25, 13, which states that for a partial termination, the lessee decreases the carrying amount of the right-of-use asset in proportion to the reduction in the underlying asset. And I'm not aware of any scenario where this approach would be unacceptable. So let's walk through the details and calculate the adjustment using this method. So we'll delete out our reduction here, and then we'll start by reducing our right-of-use asset by 30%. So let's head to our right-of-use assets section. We'll delete out all of this work and start over. So the first item we need is the amount immediately prior to the modification. And we can find that in the orange highlighted row. That is $155,567. Then we need to reduce this by 30%. So we'll add a line here and call it 30% reduction in right of use, and calculate this as negative 0.3 multiplied by our pre-modification balance. Then as part of this method, we also need to calculate a 30% reduction in the liability. So let's do a very similar thing in our liability section here. We'll add a couple rows to the top. Just reset that formatting. This first line will be the pre-modification balance. Again, we can find that in our orange row. It's $180,927. And then if we copy this 30% reduction line, we'll just rename this to 30% reduction in liability. And now you can see if we reduce our liability by 30%, that will represent a $54,278 reduction. For our right of use asset, the 30% reduction represents $46,670. And as part of this process, the difference between those amounts is recorded as a gain on lease modification. But we're not quite done here. If we again just do some scratch work, if we take our pre-modification liability balance and subtract off this 30% reduction, you'll see that would equal a lease liability of $126,649, which does not match the present value of our recalculated payments of $144,653. The opening liability post-modification must be the present value of those future payments. So we need to calculate the difference between these two amounts. So we'll add a row here to our lease liability, and we'll call this remaining change. And this will be calculated as the present value of our future payments less the sum of this pre-modification balance and the 30% reduction, which represents a difference of $18,003.87. Then our final step in this process is to adjust the right of use asset for this remaining difference so that the right of use asset and liability remain aligned. So we'll add another line here for difference in liability, and let's just clear out that hard-coded formatting, and then we'll link to that amount above. Once we do this, you can see our opening right of use asset immediately post-modification will be $126,900.75. Now, we won't do the math, but for reference, if we had used method 1 and reduced the right of use asset by the 20.1% change in the liability, the right of use asset would be reduced to $124,377 instead of $126,901 under method 2. In our example, the difference is small, likely immaterial, and either method would probably be acceptable. But as noted earlier, that's not always the case, and I prefer this method 2 as the safer choice. So now before we make our modification journal entry, let's complete our schedule. First, we'll update our right of use asset opening balance, set that equal to our newly calculated amount, and zero out the amortization in the first period. Then we need to work on our operating lease expense a bit. Let's clear this out and we'll recalculate it from the ground up. Just like in our remeasurement, we need to calculate the total post-modification expense. So before we do anything, let's actually update this total line to reflect that. Then to begin, we'll grab the total lease payments made during the lease term, and we can find that in our lease total rows down here, $345,112. Then we need to add anything pre-commencement. So this lease had both a prepaid lessor payment and an incentive received from the lessor. So we'll add lines for both. And then we can find these on our archived schedule. We'll link to them here. And we can copy this down for the incentive. It's just the row right below. And now we need to subtract off all the expense we've recognized up to the modification. So we'll say previously recognized. And this will be negative, and we'll link back to the cumulative lease expense in our orange row here. Now, once we do that, if you look in the bottom right-hand side of your screen, you'll see that our right of use asset is not amortizing to zero, which at first glance seems a little bit odd. We're taking the total consideration paid under the contract, subtracting off our cumulative lease expense. That should give us our remaining lease expense. We calculate the straight line expense by dividing that by our remaining term. So we've followed the same process that we have in the past. Why is this not working out? Well, it's because when we make our modification entry, we will recognize a $7,608 gain in connection with this lease. And I can prove that to you if we just go do some scratch work down at the bottom here, and we take the 30% reduction in our right of use, less the 30% reduction in our liability. Remember, ASC 842 requires this to be recorded as a gain or loss on modification, and that total equals $7,608. So that gain will run through our profit and loss as part of this lease, which has the effect of reducing the total expense we've recorded for this lease in our P&L. So we need to account for this in our operating lease expense section. So we will add a row here, and we'll call this gain, and in parentheses loss on modification. And then we'll calculate this as the credit to our right of use asset less the debit to our liability. And now if we update our post-modification expense to sum up every item here, you could see that will increase the straight line lease expense we need to recognize over the remaining term. And now on the bottom right, our right of use asset is amortizing to 0 by the end of the lease term. So the last thing we need to do here is just update our check. Let's update this lease expense to the final row. So be the cumulative lease expense here. We'll do the same for our cash payments. And now, because our lease expense is not the only thing flowing through our P&L in connection with this lease, we need to add in that gain loss on modification. Except in this case, we're presenting expenses as positive, so this will be loss, and then gain in parentheses on modification. And this will be equal to our amount above, and we'll just flip the sign. And you can see once we take into account everything that will flow through the P&L in connection with this lease, the total P&L impact will match the total consideration paid under this contract over the lease term. So with that, we're ready to go make our modification entry. Similar to what we've done for other remeasurements, just to keep things simple, we will clear out the current and long-term balances and then re-enter them with our full opening balance amounts here. So let's go do that in our accounting system. Here I have our balance sheet as of January 1st, 2028. You can see for our Denver building right of use asset, the balance is currently $155,567, and the short and long-term liabilities are $143,194 and $37,733 respectively. So now if we go make our journal entry, this will occur on January 1st, 2028. We will first debit our current liability for the amount that's there now. That was $143,194.07. We'll do the same for our long term. That was $37,732.90. Then we'll credit these accounts for our new opening balances. So for the current, that is $114,471.10. For the long term, that is $30,181.65. Then we'll do our right of use asset in two steps. We'll first credit it for that 30% reduction. That was a credit of $46,670.09. Then remember we had to adjust it for our liability. So we will debit it for that $18,003.87. And then we'll record the difference as a gain or loss on our P&L. So this will be gain, loss on lease modification. And sure enough, to balance our entry, we have that credit of $7,608. So if we save and close, you can see we've updated our right of use asset to $126,900.75. Our current liability to the $114,471, and our long-term liability to the $30,182, which all match the period zero amounts on our schedule here. Then back in our accounting system, if we just quickly look at our profit and loss statement, let's refresh this for the journal entry we just made. Now this is before we've made an entry for any of our other leases, but you can see we have that gain on lease modification of $7,608 running through our P&L for the month. And that's it for partial terminations, which, apart from a few edge cases, is probably one of the most complex modification topics under ASC 842. And with this example, we've reached the end of our subsequent accounting topics under the standard. We've covered a lot, and it's certainly a detailed topic, but if you've made it this far, you now have a very strong understanding of how to apply the ASC 842 model to account for your leases. In the next episode, we'll look at one final practical expedient the standard provides for short-term leases, and then turn to disclosure requirements.